This is Upwell, a new podcast from Only.one, featuring entrepreneurs, advocates, and leaders working to protect and restore the ocean and the planet. And I'm your host, Aaron Kinnery. Today we have Nik Mittal, the co-portfolio manager of Molecule Ventures, who is actively engaged in carbon markets across the United States. Let's dive in. Nik, thanks for joining Upwell and look forward to diving more into your work. Just to set the stage, I wanted to get a sense of your background and what brought you to the field of climate finance.
Yeah, well, thanks so much for having me, Aaron. I had a first career actually in finance, and I spent almost 15, 20 years in it. And about 5 years ago, as my soul grew dark, and I was like, hey, I need to start doing something with a bit more purpose. And I've always been deeply interested in environment and climate issues. Even dabbled with starting a business there at one time, 20 something years ago. And so exactly 5 years ago, I left and decided to make this transition. And I spent the first year sort of grounding myself in the issues, a lot of reading, some actual academic work. And then I spent a year or two in a policy role with the Environmental Defense Fund so that I could understand what was going on the policy side for climate, particularly in the United States. And then 3 years ago, I stood up a business in climate, Molecule Ventures, which I'm sure we'll talk about.
Awesome. So let's talk a little bit about Molecule. What's the focus of the work that you're doing?
Yeah. Well, our why is, we exist to drive private capital into climate solutions. And, the sort of how we do it is through fund structures that participate in regulated markets. And what we do is for now we run two large private funds that are invested in the cap and trade markets. And maybe I can use this as the time to sort of step back and sort of explain, just thinking about what your question might be about what is cap and trade, just where does that fit in? So as you probably know, and as many of your listeners do, the main, gas that causes warming is carbon dioxide or its equivalents, methane, et cetera. And so we want to lower our emissions of these gases and they mostly come from combusting fossil fuels. So any geography, whether that's the European Union, the state of California, or, the state of New York, they generally have a plan to lower their emissions. And they do that through a mix of sector-based programs where they might promote renewable energy, for instance, instead of, burning more fossil fuels, natural gas or coal for their base power load. They might do that through promoting EVs, through, an EV tax credit instead of an internal combustion engine vehicle. And so they seek to lower their emissions through a mix of sort of very sector-focused programs. And then in many geographies, they have another overarching program where they seek to limit the amount of emissions that they will allow for that geography for any group of covered emitters. So they may say, as they've said in the state of California, all large emitters that are not given a special exemption, like the military might be given or like aviation might be given, those large emitters must buy from the state allowances that allow them to emit carbon dioxide or its equivalents. And then over a few-year compliance period, they must turn in those allowances. So they buy the allowances from the state and then they turn them in. And over time, the state issues fewer and fewer allowances, and the price at which they will issue them is higher and higher. And in this way, the market serves as a price signal to force or push these businesses or encourage them into lower carbon emitting technologies. And so this program stands alongside all of the sector-based programs to work together. And the uniqueness of cap and trade can be that Unlike those other programs which cost the state money, this program raises money for the state and goes towards funding those other programs. So many of these programs allow for voluntary market participants, essentially financial players, in order to provide liquidity, harmonize between people with high compliance costs and low compliance costs. So we run two funds that participate in a select group of these markets.
And so just to talk a little bit more about these types of markets and the ones that exist in the US, how are they sort of similar across states? How are they different? How many different markets exist?
Yeah.
Are they all sort of embracing the cap and trade sort of regime and that focus?
Yeah, so that's a great question. Right now, about 25% of worldwide CO2 emissions are under some form of carbon pricing, whether that is a cap and trade market that is also called, which are also called emissions trading systems, or under a carbon tax. And the only distinction between a tax and a cap and trade market is in a tax, you set the price and the market dictates the quantity. In a cap and trade market, the government sets the quantity and the market dictates the price. So it's a freely standing market. About 25% of emissions are covered under one of these two systems. And under the cap and trade system, the largest one is in the European Union. And then the second largest one is in the state of California, which is the seventh biggest sort of worldwide economy. There is another smaller one for just the power sector in the Northeast. There are new ones developing in China, Canada, Mexico, New Zealand, the UK. But the biggest and the oldest is the EU, and the second biggest and the oldest is California. And we are currently in California's market, and we are in the market for the power sector in the Northeast known as RGGI, the Regional Greenhouse Gas Initiative.
And how do the compliance markets overlap with some of the voluntary markets? Like what are the sort of different things you might see within each?
Yeah, that's also a good question. The voluntary markets, which are known essentially as offsets, are a way for large corporates who have made net zero commitments, to meet those commitments. They can say, hey, I have a net zero commitment. I won't be able to wring out this amount of emissions from my scope 1, 2, or 3 emissions. So I'm going to offset them by either planting trees, supporting reforestation, maybe blue carbon, which is a fascinating growth area in the voluntary markets. So the voluntary markets are essentially for large corporates, and are exactly that. It is based on the company's voluntary commitment. The compliance markets are based on the government has in these geographies has said that this group of emitters must buy these allowances. And in a very small part, the markets overlap, but for the large part, you should think of them as quite distinct. In the compliance markets, in some of them, such as California, you could satisfy some small portion of your required submissions by actually turning in offsets. So you might need to turn in, if you had 100 tons of emissions, you would have to turn in 95 allowances issued by the state, but the state would allow you to turn in 5 offsets that they had also approved. So there can be some small overlap, but that overlap is also, I would say, shrinking as some, market regulators get less comfortable with the voluntary market, given some of the issues we've seen there.
And there's been a lot of growth in the voluntary market. Do you think that's being driven mostly? I mean, I guess to date, it's mostly driven by public demand from their consumers. But obviously, public policy plays a big role in this too. What's driving sort of the growth of the voluntary market space, do you think?
So I think that the voluntary market space is largely driven by sort of two factors. One is multinational coordination, that we need systems in place that do things like, pay for ecosystem services, pay for biodiversity benefits. And so the United Nations and other organizations recognize the need for that and are encouraging the creation of some of that. So how do we how do we save the rainforest? How do we save some of the remaining, old growth forests? And so that is driving part of it, and that's leading to the creation of some structures to do that. And then the second thing that's driving it is corporates. And so with the corporates, you could debate about whether it's coming from corporate sort of understanding of the problem or whether it's coming from the bottom up and the consumers pushing the corporate to do it. But I think it's very important to recognize that the voluntary markets, while they get most of the coverage, they're a small fraction of the size of the compliance market. So for instance, I believe that the voluntary market last year was somewhere between $2 and $3 billion of value. In California alone, the state may raise around $10 billion from its compliance market. And so and then if you add in all the trading and the liquidity, these compliance markets are in the hundreds of billions of dollars relative to the voluntary market.
And to that point, and you touched on this a little bit, so a state like California, you said $10 billion generated from its compliance market. I think Washington, which just put in place a compliance market, is expecting about $1 billion a year. Where does that money ultimately go?
Yeah. So in every state, it's different. And this is, one of the reasons why in the U.S., there's a long history of why this happened in the U.S., but in the U.S., one of the benefits of it being state by state is that it does give the state freedom to decide where the proceeds go. But in essence, the proceeds go to what I said previously, which is just that they go towards supporting the state's other environmental programs. So in the state of California, there's what's known as a greenhouse gas reduction fund, and all the money that the state raises goes into that fund. And then the legislature or the governor people can request for that money to be appropriated to pay for other programs, but they have to be used that way. And in fact, in California, 35% of the funds must be used for the benefit of disadvantaged or priority populations. And so, when you price carbon, one of the issues is that it's a use tax. And by their nature, use taxes are regressive, right? It's a greater percentage of the disposable income for a lower income person than it is for a higher income person. And so to ameliorate that, the state of California has said 35% of the proceeds must be used for priority populations. And so that money is invested in things like affordable housing, public transportation, clean air initiatives, et cetera. And in Washington state, interestingly, they also have this 35% rule, but they have another rule, which is 10% of the proceeds must be used for the benefit of indigenous populations. And so the programs being state by state allows for Washington to have a slightly different focus than California may have.
And some people might think that carbon credits and these markets provide a license to pollute. How should folks think really about these structures and how they either incentivize or accelerate a move towards net zero?
Yeah. So, look, nothing is perfect. I think that some of this comes from the beginning of these programs. In the early years of a cap and trade program, what you may do, which many states have done, is you may issue more allowances than there is pollution, and you issue them at a lower price. And in this way, you're easing the emitters or covered entities into the burden of complying with the program. But then over time, you ratchet down the allowed emissions and you increase the price. And so in the first years of the program, the market starts off in can start off in what's known as surplus before moving to a deficit position. But at the end of the day, I think it's important to zoom out and realize that this is the only environmental program that the state has that actually, provides funding as well. And the state of California had previously concluded that somewhere between a third and a half. So the state of California has a goal of a 40% reduction in emissions by 2030 from 1990 levels. And they had previously concluded that somewhere between a third and 40%, I should say, of that emissions reduction would be driven by cap and trade. And the rest would come from their sector-based programs. And then every 5 years, they reevaluate that and sort of analyze, hey, what are we actually going to get from cap and trade? And so they're in the midst of actually making that decision, or determining that right now.
And as you outlined, in the U.S., a fair amount of the policy activity within this space is happening at the state level. And you mentioned that gives some flexibility when it comes to allocation of funding that's raised. But should we view that as a positive opportunity for experimentation, or do we need more of a national strategy out of Washington?
Well, the window or the time to do a national strategy has unfortunately likely passed. I mean, under the Obama administration, there was a cap and trade bill, Waxman-Markey, that we couldn't get through the Senate filibuster that would have provided a national market. And after that failed, and there was no efforts to take it up again around after 2009, 2010, California moved with its program following in Europe's footsteps. And as we've seen in other sectors of sort of climate issues, California is essentially the leader and can use its might as the country's biggest state economy and as the globe's seventh biggest, to pull other states there. So like they're doing with fuel efficiency, they're doing that with cap and trade. And so now you see after that the Northeast followed with a cap and trade program for the power sector. Washington State has followed, and as you and I are starting to discuss, New York State is looking to follow as well. So while it would maybe have been nice if we could rewind the clock to have gotten that passed, a national program, that opportunity is gone, and we're moving ahead with the state programs.
And we did have, though, a major piece of progress and legislation come out of Washington with the Inflation Reduction Act and $400 billion or so in investment into the climate sector and into the energy sector. How will that impact both the climate markets, the carbon markets, and sort of the broader climate investing landscape?
Yeah, I mean, so the first thing is that is a great piece of legislation, and it's by far and away the biggest thing we have done in climate. And I do want to commend the administration for doing that. What it is doing, it is allowing for more ambition by putting federal dollars more clearly into the fight. So if you're the state of California and you see that there are federal dollars in the fight, this makes it easier for you to increase your own ambition. So the current ambition in California is a 40% reduction in emissions by 2030, as I said. They are now trying to move towards a goal of essentially tightening that further, moving to a 48 to 50% reduction in emissions by 2030 and hopefully to net zero by 2045. So this gives them more freedom to do that. They know that it's going to end up costing either their consumers or their corporates less because there is federal funding available. And so this gives everyone in the fight the opportunity to think bigger. And we're seeing that happen, albeit too slowly, albeit only in portions of the world. We're seeing it happen. Europe has moved to a 55% reduction target by 2030. California is moving to 50. Washington State is at 45. And so these, the ball the snowball is starting to roll down the hill.
And you mentioned a little bit the European markets. How does the carbon market within the EU compare to what we're seeing in the US with some of the different state markets? I imagine they're largely similar, but are there any major sort of differences or other things that are happening internationally that we should look to for inspiration?
So in Europe, the carbon market, meaning the compliance-based carbon market, it essentially only covers the power sector and heavy industry. So it only covers about 45% of their economy. Compare that to California, which is an economy-wide program. And so in California, it covers about 75% of California's emissions are covered under cap and trade. And so every market is different as to what it covers. The Northeast market actually only covers the power sector, so more like 30% of emissions. Washington State's market is more like California's. But what we can take away from Europe is that where carbon prices are 3 times, so we didn't talk about pricing but But in Europe, the carbon price is already essentially at about 100 euros. Whereas in California, we're talking it's at $30. In the Northeast, it's at $13. And in Washington State, in this new market, it's already at $50. So what we're seeing is we're starting to see carbon prices move. That's part of our firm's thesis. But what we can take from that is that, okay, so the impact of emitting is going to have more and more of an impact. So we should be able to drive down emissions more quickly thanks to these tools.
And why is it so much more in Europe? And what are the ramifications of that? Is that accelerating their progress towards renewables and reducing emissions?
Yeah, I mean, yes, number one, it is. However, Europe has some of its own structural issues, right? Like it is, very dependent upon natural gas. A lot of that natural gas comes from Russia. They have used this opportunity to, they have used what's going on with Ukraine as an opportunity to sort of deepen their commitment to the green transition. And so you are seeing faster change in Europe than you are seeing in America. But I think that what we can say is that Europe is leading the way. California is following closely behind, and now we're starting to see some other states follow in California's footsteps on the U.S. level.
Beyond the obvious of just more activity by policymakers, what could either accelerate the growth of carbon markets, or on the flip side, what could derail its growth?
Yeah. With regards to accelerating the growth, it's really, a political thing. At this point, it really tends to be Democratic, large D Democratic, the Democratic Party led initiatives. So when they're firmly in power in states like California, Washington State, we tend to have carbon pricing develop more robustly, more quickly than that is not the case. At this point, these programs are grandfathered in and have raised so much money for these states that they're sort of here to stay. But in terms of accelerating that, what we need sort of the state legislature in New York State to follow Governor Hochul's sort of calls for a cap and trade market. We need the Pennsylvania legislature or the new Pennsylvania governor, who is a Democrat, to follow the previous Pennsylvania's governor's calls for a carbon market. So we need to Pennsylvania is a huge state because it has so much power generation in it. And so we need to see those types of things happen for the growth of these markets to continue.
How will price parity for renewable energy, or in some cases it's even cheaper than fossil fuels, how will that impact the carbon markets?
Yeah, so the place where you see that is essentially in renewable energy credit pricing, or what states are doing through their RPSs. An RPS is a renewable portfolio standard, and in an RPS, a state specifies what percent of their retail electricity or power generation they want to see coming from renewable sources. And so what this pricing parity has allowed for is that it has allowed for these states to have RPS targets that are advancing and very high. So, compared to 5 years ago when in the Northeast they last evaluated their cap and trade market, the RPS targets have moved forward sort of 25, 30%. Most of these RPS targets are, somewhere in the 50 to 100% range, with some target for getting to 100% clean and some for 50 or 60% clean. And so what that means is that given that they have that goal in place and a system of carrots and sticks to achieve it, they can then be tighter on what they want to achieve through cap and trade. So it's one of these things where we can now look at these cap and trades markets and say, hey, they're going to increase their goal in cap and trade because the goal in RPS has already been increased. So the two work in concert. That RPS is one of those sector-based programs that I touched on previously that works alongside cap and trade to lower emissions.
Final few questions, and I'm really going to sort of broaden out beyond carbon markets.
Yeah.
You're on the board of JetBlue, and you're focused on many of the company's ESG initiatives. What are you seeing either at the company or in the broader aviation space when it comes to carbon mitigation and offsets?
Yeah, so the aviation industry is a great example, I think, of international cooperation. Aviation emissions are they're about 2 to 3% of worldwide emissions, but aviation has been growing essentially at 2 times the rate of GDP for the last sort of 4 decades. So you should assume that their emissions have also been growing, and then the other thing is that how do you control for these emissions, because where do they take place, and what is the geography that's getting control for them. So we have just put in place a sort of global framework for emissions reductions through aviation, essentially through offsetting. It's a program called CORSIA, which is one of those wonky acronyms that stands for the Carbon Offsetting and Reduction Scheme for International Aviation. But it is essentially a program through which all of the developed geographies and their carriers have agreed to limit their emissions growth or curtail or stop their emissions growth through the purchase of offsets. Now, beyond that in aviation, and where the real rubber is going to meet the road in aviation is through sustainable aviation fuels. And these are fuels that are come from biomass, and then on a life cycle analysis basis may have lower emissions by sort of 50 to 80% than conventional jet fuel. And so one of the things, you asked about the Inflation Reduction Act or Build Back Better. One of the things that these bills, or the Infrastructure Act, I should say, that these bills did is provide more funding for sustainable aviation fuel. So that is the biggest immediate growth area where policy is needed, where funding is needed, where development is needed. But that is going to determine, what happens with airlines and airline aviations over the next decade.
How close do folks think we are to those new types of fuels?
We're much, so that, like, if you think about it, offsets are here. SAF is around the corner, meaning there is some sustainable aviation fuel, but not enough. There's not enough supply yet for airlines to satisfy beyond 1%, let's say, of their demand. But SAF is here and growing very quickly, much more quickly than demand is growing. So offsets are here. SAF is emerging. Then after that, then you also have other things that would drive improvements, next gen planes, next gen air traffic control. So that's around the corner. Then sort of a decade or two away might be hydrogen, and then perhaps full electrification. So, it's a timeline of what's now and then what's 20, 30 years from now. We're moving from offsets and then to hopefully SAF to eventually maybe to hydrogen or electrification.
I was talking with someone a couple of weeks ago who's pretty senior with the Navy, and the Navy is also investing a lot of research into decarbonizing shipping and fuel alternatives. And they have quite a few options. It's just the price point right now actually exceeds the congressional mandate on how much they can spend per gallon of fuel. So there's some, I think, work that needs to be done there, and perhaps maybe the IRA or other investments will bring that cost down, and then even the Navy will be more fuel efficient.
Yeah, I think that's totally right. I mean, one of the developments that we're seeing in the aviation space is that some of these forward-thinking corporates are willing to pay that green premium so that their employees fly essentially using SAF. So, if you can say, okay, I have 1% of my fuel is SAF, and then you can allocate that 1% to those employees that are flying on your planes, that's a way of bridging that divide, and also helping those companies meet their net zero commitments. So that's something that's going on in the private sector. Now, I'm not sure if that's applicable to the Navy.
Yeah. But again, this is the theory of either carbon offsets or carbon credits and the purchase of allowances, is that resources that are generated from those activities will go into investing into scaling these technologies and ultimately reducing the costs. What other opportunities within the climate sector are you most excited about? And are there other emerging or breakthrough technologies that you think are especially promising?
Well, I think that, a lot of it right now, the places that are the most promising are focusing on one is the blocking and tackling of all the things unleashed by the Inflation Reduction Act. So, solar is at beyond price parity. And now, thanks to some big changes in the Inflation Reduction Act, we are really talking about distributed generation. We're really talking about microgrids. We're really talking about like trying to get rid of sort of the permitting issues and some of these other things. So we're working on these inefficiencies, and I think resolving them is the most key. Beyond that, when we start talking about some of the really next gen technologies, it's really hard to distinguish between things like, let's say, hydrogen or capture. What is going to come first, and we need both, right? But it's sort of outside of the frame of my competence to be able to sit here and tell you like, okay, I think one is going to lead the other. But I'm excited that one of the things that these bills did is also provide funding for R&D and for RPE and tax credits for things like capture. So we're trying to do it all right now.
Last question. For folks who might be in traditional finance as your background or working in business and are really interested in the climate space, just from your own journey of learning more about the issue areas and sitting sort of the nexus of policy and business, what things might you recommend that they look at, read, explore a bit more deeper to build their own knowledge base and to sort of understand the complexities of the challenge and the possibilities in solving it?
Yeah, that's a great question, and one that I feel like I'm going to have to write a book about because I've gotten asked it a lot. I think it's super important to understand the policy framework. And if you understand the policy framework, by understanding history is how you avoid repeating it. And so I think that's super important. And there's lots of ways to do that, whether that's through sort of, there's the larger NGO organizations that you can find some type of seat at the table to, but there's also a ton of smaller ones that are doing super interesting work in your backyard and that are focused on advancing, there's citizens agendas and citizen groups in New York that are focused on advancing the policy framework in New York. So I think just starting to understand that will help you figure out like, okay, how can I bring my skill set to bear on where I see the weak links here? And so I would start there.
Great. Well, I really appreciate you taking us through all of this in such a clear and simple manner. And when you do ultimately write that book, we will definitely have you back on the podcast.
Thanks a lot.
But thank you so much, Nik. It's great to see you.
Yeah, nice to see you, Aaron. Thank you.
Thanks again, Nik, for sharing such a helpful background and vision on how carbon markets are helping to transition the country and the world towards net zero. I'll leave links to where you can find Nik and Molecule Ventures in the show notes, which you can find at only.one/Upwell. Once again, that's only.one/Upwell. This week's episode was engineered by Jake Bowles, research was supported by Serena Cooper, and our cover art was designed by Joanna Marcus at Only.one. Make sure you subscribe to the show wherever you listen to podcasts, and start your journey to help save the ocean and fix the climate today at only.one. For as little as $9, you can start planting coral and mangroves and removing plastics and carbon. Again, that's www.only.one. Thanks for tuning in, and we'll be back next week with an all-new episode of Upwell.